Good afternoon, this is Sean Golding with Golding here to touch on a very specific question we get oftentimes from taxpayers who used to be residents who are no longer residents of the US. And what do you do if you have a 401k in the United States? You're a non-resident, no longer a US person, and you want to start collecting pension, 401k specifically, let's say, and other similar types, but not Social Security, different rules, and not public pension, different rules. Can the US tax you? Will they tax you? Typically they can, and they will, but if you're in a treaty country, you may be able to claim treaty benefits. So let's go through the basics. 401k, a lot of people in the US have that, private pension. What happens is you defer, you put tax deferred money in there, it grows tax deferred, and then the idea is when you take distributions down the line, it will have grown a lot, tax-free, and presumably you're in a lower tax rate than you were during your active years, and so you're making money that way. The U.S. taxes you, but presumably you'll be in a lower tax rate than at the time you earned it. Non-residents, right? So generally you're a non-resident. Let's say you don't get taxed in the U.S. unless you have U.S. sourced income. So if you're a non-resident, let's say you're living in a treaty country like Australia, Italy, France, and you used to have a 401k when you lived in the U.S. Now you live outside and it's grown a lot, it's done well, and you want to start taking distributions. What do? Well, the first thing is withholding, right? You are no longer a U.S. person, and so generally what will happen is the administrator will withhold 30% under FDAP, fixed determinable annual periodic. It's not ECI, right? And so they can withhold 30%. So the first thing you would do is file a W-8-BEN, which is what non-residents do instead of filing W-9, which is what U.S. persons, lawful permanent residents, and other residents file. And so in the W-8-BEN, you can identify what portion of the treaty you're relying on in order for the administrator to reduce or eliminate the withholding amount. There's a certain amount they're supposed to withhold, 30%. The treaty may reduce it to 20%, 10%, no withholding. It just depends. Typically around 15-20%. But that doesn't mean that you don't have to do anything beyond that, right? So that, let's say you collect $40,000, right? And you're like, well, okay, now what do I do? Is the U.S. going to tax it? Well, you're a non-U.S. person, right, who has U.S. sourced income, 401k, and so you have to file a tax return, 1040-NR. And so here's what you can do. If you're a non-resident and you're living outside of the U.S., then you wouldn't file a 1040, you file a 1040-NR, non-resident 1040. And what you do is you also include an 8833. An 8833 is in order to claim a treaty position. You're going to rely on a treaty position that says that you don't have to pay tax on it. And let me give you an example. If you look at like the Australia US tax treaty, it's a common one, article, I believe it's 18, paragraph 1 will say something along the lines of the contracting states, the two different countries. If someone's a resident of state A, let's say they're earning pension 401k, let's say. It won't say 401k, but you're earning pension in the other state. Well, it's the state of residence that gets the opportunity to tax, not the state of source, so the country of source, right? So in this type of situation, the U.S. would be the country of source. The non-resident lives outside of the U.S., and so the U.S. would not have the opportunity to tax. It doesn't mean they didn't withhold. It just means they shouldn't have the opportunity to tax it. It should only be taxed at the country of source. So then that non-resident taxpayer will go ahead and file a Form 8833 along with the 1040-NR, taking the position that under Article 18, or whichever article is, depending on what treaty it is, or updated treaty, et cetera, that they shouldn't be taxed on that pension 401k. There are some discrepancies between whether it's annuity or if it's lump sum. Same rules don't apply for U.S. citizens or lawful permanent residents in general, things like the savings clause and things of that nature. If you are a lawful permanent resident and you're living outside the U.S., you can try to take the position that you're a non-resident for U.S. tax purposes, or you should be treated as such under the treaty, and then you can take that position along with that. If you're out of compliance, there are various programs you can use to get into compliance depending on what your issue is. There's things like the voluntary disclosure program. There's the streamlined procedures, domestic and foreign. They both refer to offshore. It just depends on whether you're a U.S. resident or foreign resident. There's also delinquency procedures, or versions of it now. It was updated November 2020, and there's always reasonable cause. If you can show that you acted with reasonable cause and not willful neglect, you can only get the penalty removed or abated. We have lots of free information on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.